Our base case is that job market is holding up reasonably well. We saw unemployment rate, go down actually from 4.3 to 4.2. If you look at what the Fed's expectations are, they're expecting it to move up gradually and then kind of stay flat around 4.4%. So, again, base expectations would be just for the job market to let some of the steam out, but not to be cracking, so to say. But to your point, if it were to be much more of a weaker number and things are looking a lot softer from a job market perspective, unemployment rate starts spiking, then the market is going to start pricing in that 50 basis points pretty quickly versus the 25. And right now it's basically a toss-up between 25 and 50 basis points.
Are you comfortable moving up the risk curve, Anders, when we're still not out of the woods in terms of potential defaults and delinquencies, and how do you balance that with perhaps staying in quality and IG credit?
Yeah, I mean, I would say you prudently need to do that and tie back my diversification kind of point and making sure you're diligent in your underwriting. So we've been, basically focusing a little bit more on the higher quality aspects of, say, high yield and leveraged loans, which are further out in the risk spectrum for sure. If we look at the corporate fundamentals, particularly in the U.S., they're actually holding up really quite well. Companies have been preparing for a recession or potential recession for some time now, and particularly after the Fed went with their 50 basis points cut, there's a lot more comfort for us, at least, that they are going to be staying on top of what's happening here, and that soft landing scenario is increased in probability. So our concerns around a hard landing has been fading, so to say, which makes this more attractive from a corporate credit perspective.